Welcome to the True P&L Deep Dive. Before we start, a quick disclaimer. This analysis is for educational purposes only and does not constitute financial advice. Always do your own research. Now, let's get into the numbers.
All right. Today we're going deep on Ceylon Cold Stores, or CCS. We're looking at their first half results for the 2025-2026 financial year. And our job today as analysts isn't just to, read the report back to you.
Right.
Our mission is to find the true P&L, to get behind the official story and figure out what's actually happening on the ground operationally.
And look, as soon as you open this report, something just jumps off the page. It's a real financial puzzle. We're calling this first part the paradox of growth and profit compression. It's an anomaly.
It really is.
Yeah.
On one hand, you have what looks like a runaway success. The top line numbers are frankly spectacular.
Just how good are we talking?
We're talking about a revenue surge of 16% in just 6 months. That brings them to LKR 88.15 billion. In this kind of market, that signals, incredibly strong demand. Customers are voting with their wallets.
16% is huge. That's just they're taking market share, their pricing is right. Everything seems to be clicking.
Exactly. That's the story the top line tells you. It's the story of success.
But then, and this is the big but, you scroll down the income statement to the line that matters most to us as investors, the profit that actually belongs to the shareholders.
And the music just stops. All that energy, all that growth, it vanishes.
It's almost perfectly flat. Profit to equity holders. It crept up by just 1%. To LKR 2.45 billion.
So how do you explain that? How do you get a 16% jump in what you're selling, but only a 1% increase in what you're keeping? It just doesn't add up.
It immediately makes you skeptical. It suggests a serious problem somewhere in the middle, a leak in the bucket between revenue and profit.
And the mechanical reason for that leak, the immediate culprit, is pretty clear when you look at the margins. Widespread margin compression.
Okay, let's unpack that because it's a textbook case of where a company can go wrong. Let's start with the most basic one, gross margin.
Right, so this is just revenue minus the direct cost of the goods they sold. And that margin fell from 14.52% down to 13.53%.
That's nearly a full percentage point drop. On LKR 88 billion in sales, that is a colossal amount of money that just disappeared.
It's a huge number. And it tells us that their cost of sales grew faster than their revenue. You see it right there in the numbers. Cost of sales spiked 17%, while revenue, as we said, was up 16%.
So why does that happen? What are the potential causes?
Well, there are two main possibilities. Scenario one is they lost their pricing power. Maybe the cost of raw materials or transport or anything in their supply chain went up, and they couldn't or wouldn't pass that extra cost on to the customer.
Which could happen if the market is super competitive, right? They'd rather absorb the cost hit than risk losing customers by raising prices.
Precisely. They chose volume over margin. The other scenario two, is that the new growth they got was just less profitable growth.
What do you mean by that?
Maybe that extra 16% came from opening stores in new, less profitable areas. Or maybe they ran huge, costly promotions and discounts to steal market share from a rival. The sales look great, but the profit on those sales is much thinner.
And the problem doesn't stop at the gross margin, does it? It gets worse as you go down the P&L.
It absolutely does. The operating margin, which includes all the other costs of running the business, distribution, admin, marketing, that dropped too. It went from 6.26% down to 5.72%.
So it's not just the cost of the goods, it's the cost of running the whole machine. Everything is getting more expensive for them faster than their sales are growing.
And that all culminates in the net margin, the final take-home profit. And that suffered the biggest squeeze of all. It contracted from 3.18% to just 2.77%.
For every 100 rupees in sales, they're now keeping less than 3. That's a razor-thin margin.
And you can't even blame it all on operations. We saw a pretty hefty 20% spike in their tax bill, too. So even the smaller profit they managed to make was getting hit harder by taxes.
So if we stopped our analysis right here, just looking at the income statement, what would the verdict be?
The verdict would be simple. Great at selling, but really poor at managing costs and defending profitability. It looks like a classic case of profitless prosperity.
But as you said, we're here to find the true P&L, and the income statement is often just accounting noise. It's not the same as cash.
And this is where the story gets really, really interesting. This brings us to section 2. Cash is king. For any serious investor, you have to learn that cash flow often tells a much truer story about a company's health than net profit.
And the difference here is Well, it's staggering.
It is the single most fascinating number in this entire report. So remember the net profit figure, LKR 2.45 billion.
Right. The disappointing 1% increase.
Okay, now look at the operating cash flow, the actual hard cash that the business generated from its day-to-day operations. It was LKR 6.77 billion.
Wait, say that again. 2.45 billion in profit, but 6.77 billion in cash.
Exactly. It's almost 3 times higher. To put a number on it, their cash conversion ratio was an absolutely eye-watering 277%.
277%. So walk us through that. What does that actually mean?
It means that for every single rupee the accountant said they earned on paper, LKR 2.77 in cold, hard cash actually flowed into their bank account. It's the definition of cash-generating excellence.
How is that even possible? Where does all that extra cash come from if it's not from profit?
Are 2 main drivers. The first is non-cash expenses. Think about a company like CCS. They have supermarkets, factories, a whole fleet of trucks.
A lot of physical assets?
A ton of physical assets.
Yeah.
And every year, accounting rules say you have to book an expense called depreciation, which is the value those assets lose over time.
Right, but you're not actually writing a check for depreciation. No cash leaves the building.
Exactly. It's a paper expense. It reduces your net profit, making it look lower, but it has zero impact on your cash balance. Since CCS is investing heavily, their depreciation charge is high, which artificially pushes down the profit number relative to the cash flow number.
Okay, so that's part of it. The accounting is making profits look a little worse than the cash reality. But that can't explain a 277% ratio on its own.
Not even close. The real magic, the truly impressive part, is their management of working capital. This is where the management team shows they are masters of the operational game.
And we can see that specifically in one line item, trade receivables.
Yes, trade receivables is the money that customers owe you. And here's the crazy part. Even though their revenue shot up by 16%, meaning they sold way more stuff, the amount of money owed to them actually plunged by 22.7%.
So they were selling more, but collecting cash from their customers dramatically faster than before.
Dramatically faster. We measure this with a metric called Days Sales Outstanding, or DSO. Theirs fell to just 16.8 days. That is incredibly efficient.
So what does that do for cash flow?
Well, think about it. It's like a massive one-time injection of cash. If you suddenly collect all the money you were owed from the last few months, all at once, your bank account swells. That inflow shows up directly in your operating cash flow, which is why it's so much higher than the net profit.
That is brilliant operational management. But I have to ask the skeptical question here, is that sustainable?
That is the right question to ask.
I mean, a 277% cash conversion ratio feels like a one-off trick. Did they just squeeze their customers really hard this quarter to make the numbers look good? Can they repeat that next quarter?
Probably not. A big working capital swing like this is usually a temporary boost. You're right. They've essentially pulled forward cash from the future into this period. We'll have to watch if receivables creep back up. But for this half, you can't deny the result.
So for now, the verdict is that operationally, CCS is a textbook cash efficiency machine.
Without a doubt. They are brilliant at turning a sale into cash. Which brings us to the billion rupee question. If they are so good at generating cash and their core businesses are growing, where did the profits go?
Exactly. This leads us to section 3, operational health. We need to find the source of that margin compression. Was it in the supermarkets and factories, or was it somewhere else?
And this is where we can prove that the core business is actually very healthy. The problem isn't on the front lines. Let's start with the biggest piece of the pie, the supermarket segment.
This is the engine of the company, right? It's 80% of their revenue, LKR 70.7 billion.
It's the behemoth. And look at its segment profit. That's the profit before you allocate any central head office costs. That segment profit grew by 21.4%.
Okay, that is a critical number, a 21.4% profit growth.
It's massively important. It shows that the underlying retail business is not only growing, it's growing profitably. They are managing their store-level costs so well that profit is growing even faster than their sales. The core is strong.
And what about the other segment, manufacturing?
It's the same story. Maybe even better. Their segment profit was up an incredible 27.4%. So again, strong customer demand for their products, and they're making them more efficiently than ever.
So both of the core businesses are, as you'd say, firing on all cylinders. The people running the stores and the factories are doing a fantastic job.
Absolutely fantastic job, which makes the final 1% profit growth number even more baffling.
This is the real mystery of the report. If your two main divisions are growing profits by over 20%, how on earth does the final number for shareholders end up at 1%? This brings us to the second big lesson for investors. Hidden costs kill.
And we found the killer. The strength of those segments was completely wiped out by what I can only describe as an operational black hole at the corporate level.
We're talking about unallocated corporate costs. So this is the head office, the CEO's salary, central HR, group IT, all the overhead that isn't tied to one specific store or factory.
These are management's own costs. And the change here is alarming. Last period, these costs were already a drag on profit of about LKR 700 million.
Okay.
This period. That drag exploded to LKR 1.79 billion.
Wow. That is a swing of more than $1 billion rupees. LKR 1.08 billion to be exact.
That LKR 1.08 billion is the entire story. That is the missing profit. That's true. So maybe this LKR 1.08 billion is an investment. Maybe they spent a huge amount on a one-off marketing campaign to drive that growth. Or maybe they're investing in a big new IT system, like a cloud platform, that costs a lot up front but will save money later.
Or what about reorganization costs, severance packages, things that are painful now but set them up for a leaner future?
That's also possible. But if it's a strategic investment, management has a duty to explain it to shareholders. They need to say, we spent this billion rupees on X, and we expect to see a return on it by Y. Right now, it's just a black box.
And it's a billion rupee black box.
Yeah.
As an investor, you have to demand an explanation for that. Segment performance is meaningless if the head office is just burning cash.
Exactly. So we've got this paradox. Flat profit, amazing cash, and a huge spending problem at the corporate level. Now let's see how all this impacts the company's financial foundation. Let's move to Section 4, the balance sheet and liquidity.
Right. Is there a hidden risk lurking beneath that stellar cash flow number?
Well, let's start with the assets. Total assets are pretty flat at around LKR 81.9 billion. The company isn't getting bigger overall. But inside that number, there's a lot of movement.
Specifically in property, plant, and equipment, or PPE.
Yes, PPE is up by LKR 1.03 billion. This confirms they are reinvesting heavily in their physical infrastructure, building new stores, upgrading factories, buying new trucks. They're spending money.
And here's where it connects back to our cash discussion. How did they pay for that billion rupee investment?
They paid for it largely with the cash they generated by shrinking their receivables. They turned a current asset money owed to them directly into a fixed asset, a new building. It's smart, disciplined internal funding.
That's a sign of a well-run finance department. And there's another efficiency metric that looks good here too, right? Inventory.
Yes, inventory days are at 35.5 days. For a company that's both a retailer and a manufacturer, that is ultra efficient. They are not letting stock pile up on shelves or in warehouses.
So on all the operational efficiency metrics, collecting cash, managing inventory, they get an A+.
They do. But, and this is a very big but, now we have to turn to the other side of the balance sheet, the liabilities. And this is where we enter the liquidity danger zone.
This is about their ability to pay their short-term bills. And the numbers here are, they're not good.
They are alarming. Let's start with the current ratio. It's at 0.68.
For anyone listening, you generally want that number to be at least 1.0. A ratio of 1.0 means your short-term assets are enough to cover all your short-term debts.
At 0.68, they are significantly short. If every supplier and bank demanded their money back within the next year, CCS would not have the liquid assets to pay them.
And it gets even worse if you use the quick ratio, right? Which strips out inventory because you can't always sell it instantly.
The quick ratio is a shocking 0.29. It's incredibly low. It tells you the company is walking a tightrope. They're completely dependent on selling their stock and constantly rolling over their debts to stay afloat.
So how are they managing this? How does a company operate with such low liquidity?
They are doing it by heavily relying on their suppliers for financing. This is the other side of their efficiency coin. They collect cash from customers in 17 days, but they are stretching out payments to their own suppliers.
We see that in the trade payables line. It's a huge number.
It's LKR 21.46 billion. They are essentially using their suppliers as a source of interest-free loans. And on top of that, they're using LKR 7.22 billion in bank overdrafts, which are very expensive short-term loans.
So the big takeaway for an investor is that this whole efficient operation is floating on a sea of supplier credit and short-term bank debt.
Exactly. It's a high-risk strategy. It works as long as the economy is stable and their suppliers are happy to wait for their money. But if credit markets tighten or suppliers get nervous, they could face a serious liquidity crunch, very fast.
So there's a real fragility there. But what about the longer-term debt picture?
That's a little more comforting. Their debt-to-equity ratio is 67.76%, which we'd call moderate. They're using debt, but they aren't completely drowning in it relative to the size of their equity.
And they can afford the interest payments.
Yes, the interest coverage ratio is a healthy 4.11 times. Their current earnings can easily cover their interest costs, which is a good sign for lenders and gives them a bit of safety cushion.
So to sum up the balance sheet, operationally brilliant in managing working capital, but carrying a very high risk in its short-term liquidity because of how it funds itself.
It's a delicate balancing act. And that brings us to the final piece of the puzzle, Section 5, the capital strategy conundrum. What did management actually do with all that cash they generated?
Right. So let's calculate the real bottom line for cash. Free cash flow. That's the cash left over after they've reinvested in the business.
We start with the operating cash flow, which was that huge LKR 6.77 billion number. Then we subtract capital expenditures, or CapEx, the money they spent on PPE.
And CapEx was huge this period. LKR 3.25 billion.
A massive number. It's up 67% from the last period. Management is not sitting still. They are aggressively investing in growth.
Okay, so LKR 6.77 billion in cash comes in, LKR 3.25 billion goes out for investments. That leaves a free cash flow of LKR 3.52 billion.
And that is a very strong number. Even after a huge investment cycle, they still generated LKR 3.52 billion in surplus cash.
This is the critical point. They had billions in spare cash. So the next question is, what did they do with it? And why? If they had so much cash, did they still need to take on more debt?
This is where management's priorities become crystal clear. Let's add up all the ways they use cash. CapEx, dividends, lease payments, finance costs. The total cash they deployed was over LKR 7.64 billion.
Wait, hold on. Their cash inflow from operations was 6.77 billion, but their cash outflow for spending was 7.64 billion.
Precisely. They spent more than they generated, creating a funding gap of almost $1 billion rupees.
And to fill that gap, they had to go out and borrow LKR 1.58 billion in new long-term debt. Even with world-class cash generation, their appetite to spend was even bigger.
Which leads us to the most controversial decision of all, the third lesson for investors, the dividend trap.
This feels like a classic case of management trying to keep shareholders happy in the short term, maybe at the expense of the long term. They paid out LKR 2.84 billion in dividends.
LKR 2.84 billion. Now, you have to compare that to what the company actually sustainably earned. The best measure for that is total comprehensive income, or TCI.
Yeah.
And TCI was only LKR 2.10.
So they paid out almost $3 billion in dividends from earnings of only $2.1 billion.
Which gives you a dividend payout ratio of 135%.
They paid out 35% more than they earned. But hang on, you could argue they could afford it, right? We just said their free cash flow was LKR 3.52 billion. The dividend was covered by cash flow.
It was covered by cash flow this period, yes. But that cash flow was artificially inflated by that one-time working capital improvement. You measure a dividend against earnings because earnings represent sustainable performance.
And what happens when you consistently pay out more than you earn?
There's only one possible outcome. You erode the value of the company. You are literally giving away pieces of the business. And we see the proof right there in the numbers. The net asset value, or NAV, per share fell. It went from LKR 25.22 down to LKR 24.49.
So they are funding today's dividend by taking value from tomorrow's balance sheet.
Or by taking on new debt. It raises a huge governance question. Why are you paying a 135% dividend and taking on new debt when you have a billion rupee cost problem in your own head office?
A prudent management team would fix the cost bloat first, secure the balance sheet, and then pay a responsible dividend out of sustainable profits.
But instead, they're doing the opposite. They're accelerating spending on all fronts. CapEx up 67%, plus an unsustainable dividend, and funding it all with a fragile balance sheet and new debt. The operational excellence is being completely undermined by strategic recklessness.
Which brings us to the end, Section 6, our conclusion and the final investor verdict. We have to weigh all these conflicting pieces of evidence.
Let's start with the key ratios. The annualized return on equity, ROE, is 20.7%. On the surface, that looks fantastic.
But we have to ask where that return is coming from. And we know the answer. It is heavily leverage-driven.
Exactly. When you see a company's return on assets is only 5.97%, but its return on equity is 4 times higher at 20.7%.
The difference is debt. The leverage is amplifying the returns, which is great when things are going well, but it can be disastrous when they're not.
So what is our final true P&L verdict?
I think it has to be a split decision. The company is, without a doubt, operationally strong.
Yes. Amazing cash conversion, efficient core businesses, tight control over inventory and receivables. The teams on the ground are executing flawlessly.
However, the company is strategically risky, and that risk is being driven by decisions made at the very top.
The uncontrolled corporate cost bloat is risk number one. The extreme 135% dividend payout is risk number two, and the deteriorating short-term liquidity is risk number three.
The growth story here is real. The potential is enormous, but it's being held back by two huge and frankly fixable management mistakes.
First, they have to get a handle on that LKR 1.08 billion in corporate costs. That is the easiest way to unlock massive profit growth. Second, they have to bring the dividend back to a sustainable level.
If they don't, they're just going to keep eroding the value of the company, even while the frontline business does well.
And that leads to the final provocative thought we want to leave you with. It's the central question for anyone considering this stock.
Should an investor focus on that high leverage-driven ROE of 20.7%? Should you enjoy the high returns and the big dividend and just accept the risk that comes with it?
Or should you be much more concerned about the slow, steady erosion of the net asset value per share? That quiet signal that the long-term health of the balance sheet is being sacrificed for today's payout. Is this a classic case of short-term gain for long-term pain?
And the test for you as an investor is simple. Watch that LKR 1.08 billion corporate cost line in the next report. If it hasn't shrunk, or if management can't give a very good reason for it, then you know the strategic risks are winning out over the operational strengths.
The ball is entirely in management's court now. They need to prove that spending was a strategic investment, not a structural failure. Until they do, a healthy dose of skepticism is definitely warranted.
Thank you for joining us for this True P&L Deep Dive. We hope this helps you look past the headlines to find the real story and the real risk hidden in the numbers.